What's up guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So we're gonna go ahead and do another mortgage rate update. The mortgage rates actually dropped today and it's not looking too bad. And then something stupid, okay? This sounds like a good idea, but California legislators, the people to be in power, they're gonna wanna go ahead and help you. Yes, you go ahead and buy a house. They're gonna help you go ahead and do with a down payment. But are they really? Well, it's something that's called an equity-based down payment that they're going to go ahead and propose to you because they want to get into the real estate business. They want to go ahead and be part of what you're trying to do. Assholes. Whatever, but let's go ahead and get on with the mortgage rate update, and then I'm going to tell you why the shared equity-based loan program that they're initiating is so stupid. Like, this is something that's been going on for such a long time. We already had shared equity programs. People have been doing it for God knows how long, but now California wants to get into the business of real estate. Morons. Okay, so we're going to be pricing out 10 different mortgaging products. It's going to be a 30-year fixed, a 15-year fixed, a 30-year jumbo, a debt service covered ratio, which is an investor loan for units to go ahead and qualify you from income instead of your W-2 or anything like that. Bank statement loans pretty self-explanatory. We just qualify you based off the money that comes into your bank statements. FHA 30-year 7.6 adjustable rate mortgage, USDA 30-year fixed, VA 30-year fixed, and a hard money fix and flip. Now we do have other loan programs, but I feel like 10 is probably 10 is extending it. But let's get on with it. So as of 6/30/2022, the 30-year fix will be sitting at 4.60, which is a decrease from the 4.8 from the previous market day. 15-year fix will be sitting at 3.88%, which is a drop from the 4.05 from previous market day. 30-year jumbo is sitting at 5.25, which is a drop from the 5.48% 30-year jumbo from previous market day. DSCR loan, debt service covered ratio loan, which is going to be dropped from, or it's going to drop to 8.10 from the previous market day of 8.45. Bank statement loan will be at 7.20, which is a drop from the 7.40 previous market day. 30-year FHA will be sitting at 4.15%. That is a drop from the 4.35 previous market day. 7.6 adjustable rate mortgage will be sitting at 4.88%, which is a drop from the 4.96 previous market day. USDA, which is one of those 0% down payment programs, loan programs that they have, which will be sitting at 4.25, which is a drop from the previous market day of 4.45. VA, which is another zero down payment mortgaging product, which is going to be sitting at 4.60, which is a drop from the 4.80 from previous market day. And then a hard money fix and flip. This is for investors to go ahead and get money to go ahead and buy rehabbed homes, or to rehab a home property that's in distress. Has be sitting at 9.15. That is a drop from the 9.25 from the previous market day. So California legislators, they're actually proposing something. Now, in the world of real estate, okay, majority of people don't know a lot of the options. That's why you have guys like me that know these things, that make it available to you. We do. These are things that big banks don't do. It's mostly just brokers that have these options available to you. And this is something called shared equity, okay? So I'm going to go ahead and lay out the proposal of what they're actually trying to do, and then I'm going to go ahead and tell you what the nitty-gritty is about, exactly why this is a terrible idea. This is a state should not be in the business of real estate. If you're going to give a down payment, it should be as a grant. It should be forgiven. It should be for you, not into a shared equitable position. But legislators are proposing $1 billion a year down payment program for the first-time buyers, given the high cost of housing and rising mortgage rates in exchange for a partial stake. Does it sound great to you? Does it sound really, really good to you so far? Because if they're trying to get into this, try to be a business partner with you, that's always great when the state of California goes ahead and wants to be a business partner with you. First-time home buyers often rely on family gifts to afford the down payment on their homes. Now California legislators want the government to fill the role of their generous relative. So the state of California is now going to be that daddy warbucks of an uncle that you have to go ahead and help you get into that house, because you know what? That's what they're there for. They're to go ahead and just assist you in any way that they see fit, and they're trying to help you out the way that they want to. Lawmakers are proposing creating $1 billion fund in this year's state budget, and will provide California first-time buyers either an all of the money they need for a down payment or very close to it in exchange for partial ownership stake in those residents. Now, the total amount that appreciation and home equity state owners have gained is about $141,000 in home equity over the past year. California state rate of home ownership is about 56%, which is the second lowest next to New York, which, I mean, it is an expensive place to live, and any place that has a very high level that is very desirable to live is going to have a lower home ownership rate. That's just a gimme, okay? Like if you live in, I don't know, in freaking North Dakota, and who the hell wants to live in North Dakota? Everybody wants to come to the Sunshine State, or they want to go to New York, or they want to go to Florida. These are the places where everything is happening. There's shit happening in like South Dakota or fucking Missouri. Nobody cares about that. Atkins said the California dream. It is not a dream, folks, okay? It is not a dream to go ahead and be a homeowner. The dream is to get yourself in an extremely well financial position to go ahead and get some sort of collateral to purchase a piece of property that is eventually over a 30-year term amortized is going to benefit the next generation. Home ownership is not going to benefit you in any way. The only thing that's going to benefit you is if you do get a 30-year mortgage and you're renting versus the other one, is you do build equity over the time, when after, like, you know, 8 to 10 years, when you start building equity into your property. But your mortgage payment will never go up, opposed to rent, which increases typically about 10% every single year. Now, what we're going to go ahead and do is I'm going to go ahead and explain to you why this is a really, really bad idea, okay? For a state, a government to go ahead. Now look, they're proposing $1 billion. They're not proposing $1 billion because they love you and you are just so great and know it's going to be kumbaya and we're just going to go ahead and we want to take care of the Californians, especially the guy, this Newsom guy. He's just he's too stupid for his own good. That's what the problem is. But this is them getting into the real estate world. That's you can't get into that because, let's say for instance, real estate does crash and you're into a shared equitable program. The state itself cannot fail. If a business fails, then a business goes and then we go ahead and open up another one. But if a state fails, it's not. I have no idea. So what I'm going to go ahead and do is I'm going to go ahead and explain to you what this shared equity based program is, okay? So let's say you and your significant other, or you yourself, or whatever it is, whatever you have, like if you're single, you have a partner, you're married, whatever it is, right? If, let's just take, I'm going to pretend like I'm California and you're going to be yourself, okay? You come over to me, you're like, hey Omar, can you do me a huge favor? And I'm like, hey, what's up, dude? He's like, I want to go ahead and buy a house. And I said, hey, no problem, that's awesome, you should go buy a house. He's like, but I don't have any money for the down payment. I'm like, no joke, no problem. How about I go ahead and front your down payment? You're like, no way, you're gonna front the down payment? Yeah, but I'm gonna go ahead and we're gonna become business partners in this. How the hell are you gonna become business partners in this? I'm like, well, listen, if you end up selling this house, I am going to take 20% of the profits on that house, including my initial investment back. So you're already at a 20% markup. I'm already at a 20% markup, whether it's 20%, 30%, or whatever it is. The proposed is going to be at a 20% stake. So if at the end of the term, the house gets sold or you refinance it or whatever happens, the equity that you have inside of that house, the majority of the upfront, first goes to them. Okay, the amount that the principal that they went to it. You're like, okay, respect, that's enough. You guys get your money back. Then on top of that, any equity that you have, so let's say for instance that appraised for higher, and you refinanced it, right? Like let's say you bought it for $500,000 and then it all of a sudden appraised for like, I don't know, like $800,000 and they gave you $200,000. Stop me if I'm losing you, okay? So if you initially bought the property for $500,000, they gave you, I don't know, $100,000, $200,000, because they're gonna go to the 20% mark, right? They're gonna go ahead and give you the 20% down payment, so we can stick on the conventional side, lower the stringent qualifications, the guidelines as far as, you know, the FHA, because FHA is a little bit harder to go ahead and deal with. And there's other 3.5% programs like conventional has, right? Opposed to FHA. So if you bought it for $500,000, I gave you $200,000. I'm gonna go and appraise, and you're gonna refinance it because whatever, you need a little cash back out of it or thing like that, whatever. So if you are now appraised at $800,000, I'm gonna go take my initial $200,000 back. Then I'm gonna take 20%, which is roughly about $60,000 from the $300,000 that you make. Now we're shared equitable partners. Now you just bought me out. Now you are gonna go about your merry way, and you're gonna go ahead and do your thing. So that is what shared equity means. Now it is great for people who want to get into the world of real estate or into a home ownership, and you need a little bit of assistance, but they're 0% down payment. I offer 0 down payment programs where you don't have to worry about shared equity, and you could do it at a 3.5, 4. You could do it at like at a 5%, right? FHA right now is at 4%. You could go ahead and do a second to go ahead and cover the rest of that, and then you don't have to share any equity of it. You hold it free and clear, and you could just go ahead and do your thing, right? And this actually has what's called the 10-year rule, right? The 10-year rule, when it gets reevaluated, the state is going to go ahead and constantly reevaluate your property value, and then they could put you in a position where they're going to make you pull out equity inside, out of your house. This is something that is just getting proposed. Now, I live in California. I love California, but these idiots that are sitting here trying to make these decisions aren't the brightest bulbs on the Christmas tree, because what happens, well, A, we have to go ahead and look at what happens if real estate prices drop. So if this legislation passes, which it's not going to pass this year, let's just face it, it's not going to pass this year. It's going to probably take another couple of years before this actually passes, because they're going to wait for the real estate market to take a hit where it dips to the lowest, where they're going to be in a more profitable position afterwards. So the biggest problem with this is if you end up foreclosing on the house, the delinquency, well, then that all of a sudden goes into an auction, or it goes to a foreclosure sale. If you do it beforehand, it's going to go into a short sale, where you are going to have to end up eating the cost if there's an initial balance left. So if you go below that 20% that you initially invested, well, now somebody has to eat the cost on that, and then the state of California, your tax dollars, you are going to go out and cover the cost on that. Number 2, a good part about this one is, unlike a lot of these other shared equitable positions that you go ahead and get where it's a 0 down payment, where somebody's helping you front the down payment, is this one is actually only 20% of the total equity that you end up building into the house, which is 0% on the total interest on the loan. They're not going to go ahead and take any interest on it, which is actually surprisingly good. Now, number 3 is going to be the bad. Now, what happens is when you put $1 billion worth of money, stimulus, into the economy as far as home ownership goes, you know what it ends up doing? They're actually manipulating the market to go ahead and increase home prices. So $1 billion leverage is going to be at $10 billion in total real estate every single year. That's what it is, okay? So $1 billion forked over, leveraged, it's going to be at 10 billion. So what does that mean? That means that if I put 20% down, right? 20% down at $1 billion, $1 billion will equal my 20%. So if you multiply it to go to the 100%, right? To see exactly what you're gonna cover for the remainder of it, well, that's gonna be the remaining value. You're gonna be leveraged to the $10 billion mark. Self-explanatory? I hope so, give or take. It's a multiples game, okay? I know sometimes it doesn't make sense, but it is what it is. That's just how it works. So if you put 20% down at $1 billion, majority of people think that you could go ahead and leverage it. Logically, it would seem to make sense at $5 billion, but it'll actually go and get extended over to the $10 billion leverage, so you could go ahead and get that real estate property, because you're constant, well, let's not get too in detail with it. I'll explain that into another video, to go ahead and give you exactly a shared equitable agreement that you're gonna go ahead and get into with whomever you get into. So that's what I think is a really, really bad idea. I think this is stupid. Any state out there, any legislation should not be in the world of real estate. You shouldn't try to get into it. This is not for you. If a real estate company fails because they went into a shared equitable position with somebody else because they're forking over the down payment, well, let them fail. This is just going to be catastrophic. This could backfire on us in a way that we've never seen. And it's going to overinflate the whole entire real estate market, or it could kind of just take it to shit. This is going to only be subject to first-time home buyers, but as far as the real estate news, what California is doing, and this could possibly be going to different states, you know, your New Yorks, your Floridas, your big state like Texas, it could be over there. Actually, Texas is pretty smart. They're probably not going to do this. But if you want up to 50% commission rebate, 0% listing on selling your current home, or any mortgaging assistance, link in the description below. And if you like the content, please like, subscribe, comment, all that other stuff, and keep yourself up to date on exactly what's going on. Till next video, guys, I really appreciate you watching. Peace.
I don't wanna waste a minute. Don't have any plans, swing it. If you gotta go, I spill it. 'Cause I need it, Money is